How's it going, everyone? Dan again, Stocktrades.ca. Been working out in my office a lot over the last 2-3 weeks, doing my part with this whole physical distancing thing. I've been putting a ton of work into our premium platform, which, by the way, if you want to sign up for free, head down below to the description. I'm going to put a link there. And as soon as you sign up for free, you'll also be given an opportunity to purchase a premium platform at 40% off. This is something we throw to free members, just thanking them for signing up for the free end, and they can get started with the premium end at a pretty steep discount. This goes along with our 30-day money-back guarantee, no questions asked. I mean, if you don't like what we do, simply send us an email and we'll refund your money in full. So in terms of this week's video, we're going to be going over 3 stocks that have outperformed the market significantly during this market crash. These stocks pay reliable dividends, they'll have consistent revenues during this pandemic, and they're stocks that investors are flocking to right now in unprecedented volatility. So with that being said, let's get started. Now before we get started with the video, let's just go over a quick recap of what has happened over the last few weeks, because it's been a little crazy. So since March 23rd, the TSX has actually returned 22.7%. The markets right now are recovering in a big way. And actually down south, the Dow Jones, which is down around 21.3% since the start of this crash, is the only American index still in bear market territory. The Nasdaq is down around 18.3% and the S&P 500 about 18.9%. The one thing to note is that all of these indexes right now are outperforming the TSX, which is still down around 23.4% since the crash. Now a lot of investors, analysts, advisors are quick to trash the TSX. They always have been, in terms of the gains being somewhat lackluster compared to the American markets. But it is important to note that our index up here in Canada has significantly more exposure to the energy sector, which has been absolutely decimated as of late. Around 16.4% of the TSX is energy stocks. If you look at the S&P, the index is made up of only around 5.4% of energy stocks. And if you look at the Nasdaq, it's only around 0.5%. The outlook for oil right now is fairly bleak, and even with these OPEC talks, some analysts are estimating that oil could stay below $30 a barrel for the rest of the year. So what does this mean for the TSX? On a whole, we can expect the TSX to struggle more than the American markets, primarily because of its exposure to the energy sector. We've had a ton of people email us about purchasing energy stocks right now, and the fact is, if you're doing it, you are somewhat speculating. We have no idea how long this COVID crisis will last. We just had the Alberta Premier Jason Kenney come on yesterday and state that unemployment in Alberta could reach 25% and Western Canadian select oil prices could hit negative values. So while these companies are extremely tempting at current price levels and could provide significant upside if the price of oil were to recover quickly, the fact is we just don't know if it will. They are in talks right now to cut production by around 10 million barrels a day, but the fact is they figure this COVID crisis will drop demand in April by up to 15 to 22 million barrels a day. So while investors are hopeful that this drop will prop up the price of oil, I personally don't see it as being significant enough. Not only are companies in the Alberta oil sands like Canadian Natural and Suncor cutting budgets and slashing production, there's actually talks of major mines in Fort McMurray shutting down, like Teck and Suncor's Fort Hills mine. I think investors looking at oil and gas stocks right now to make a quick buck don't really understand the risks they are taking and the amount of speculation that's going into an investment in the oil and gas industry right now. Another industry investors are flocking to right now is the materials sector, particularly gold miners. Now this makes sense. The price of gold has gone up by nearly 30% over the last year. And gold is often a safe haven during times of market volatility. But this situation is very unique in the fact that COVID-19 is actually affecting gold producers as well. Because of social distancing and physical distancing efforts, there's been a significant amount of production cuts and layoffs in the gold mining industry as well. Prime example of this is a popular Canadian gold company, AEM. They're often praised for mining in political jurisdictions that don't have as much political uncertainty and aren't as dangerous. But right now, they're feeling the heat. Because they operate in safer jurisdictions, there's more rules put on them because of this COVID crisis. And that has left the company to essentially idle 3 of its plants in Quebec. So this is an industry that you're really going to have to do your research in. because there is companies that are going to be drastically affected by the COVID crisis and some that won't be affected at all, depending on their countries of operation. With that being said, let's look at 3 Canadian stocks that have significantly outperformed the market thus far, and ones I feel have a really strong chance of outperforming moving forward. So there are quite a few strong companies that are outperforming right now. 2 that we're not going to talk about in this video because we've spoke on them in previous videos are Fortis and Dollarama. If you want to watch the videos where we speak on them, I'll leave a link up at the top of the video here. So the first stock we're going to speak on is another utility player, and that is Algonquin Power and Utilities. Since the start of this crash, the stock has lost just over 13% compared to the TSX losing nearly 23%. The reason for its current outperformance is pretty clear. Utility stocks are often seen as defensive in nature. We need electricity, we need water. Their revenues are going to be a lot more stable, and as such this makes their top and bottom lines more reliable, and more often than not these utility stocks do pay dividends, which usually prevents their share price from experiencing extreme volatility. The reasoning for this is as the stock price drops, its yield goes up, and as its yield goes up, it becomes more attractive for income investors looking to buy on the dip. And this is why you'll generally see the strongest dividend stocks outperform in these market conditions. The company operates in 13 states, including some of the biggest states in the US, California, Texas, and they also operate in 1 Canadian province. They have just over 800,000 customers right now, and one major benefit to the company, especially with the Canadian dollar falling right now, is the fact that they do pay their dividends in US dollars. Now in terms of valuation, Algonquin is still fairly expensive. If you compare it to industry averages, its forward price to earnings of nearly 25 is significantly above the industry average for utility companies at 17.83, and its price to book of 2.72 is nearly double the industry average for utility companies. Now there is somewhat of a justification for its higher valuation, and that is because next year analysts expect the utility industry to grow revenues at around 2.64%. Algonquin expects to grow its top line by nearly 13% next year, and the company has been one of the fastest growing utility companies over the last 4 years with a compound annual growth rate on earnings of over 50%. So why do we feel the company will continue to outperform? We base this on the fact that it is investing heavily in renewable energy. It has over 2.2 gigawatts of capacity in renewable energies, and over 90% of this generation is locked into long-term contracts. Renewable energy generation is clearly the future, and as such, investors are moving to companies like Algonquin Power. Now the next stock on our list is a consumer defensive stock that has actually outperformed the TSX since this market crash started by over 30%, and that is Metro. Metro trades under the ticker MRU and is a grocery and pharmaceutical chain here in Canada. The company has over 1,500 grocery stores and pharmacies and has one of the most reliable dividends in the consumer defensive sector here in Canada. Metro has a dividend yield around 1.4% right now, and the company has raised dividends for 25 straight years. This means they raised dividends during the dot-com bubble in 2000, and they also raised dividends during the financial crisis of 2008. And there's little reason to believe they won't continue doing so during this COVID crisis and market crash in 2020. The company's payout ratio in terms of earnings is around 30%, and it's currently paying around 70% of its free cash flows to the dividend. And while this is high, this is around the company's historical averages and shouldn't raise too much concern. In terms of dividend growth, the company has a 5-year dividend growth rate of 15%. In terms of grocers, this is by far the best dividend growth rate in the industry. And we've been getting a ton of emails from investors who want to take advantage of this panic buying that's going on. We just want to make one thing clear. We're not suggesting you look at stocks like Metro, Loblaws, which by the way, if you want a video on Loblaws, because of the panic buying, we're suggesting you take a look at these stocks because they are defensive in nature and their revenues will be more consistent during an economic crisis that we are going through and are going to continue going through in the near future. The panic buying may boost these companies' first quarter and even second quarter earnings, but over the long haul, the reason for purchase is reliability. And with Metro operating pharmacies, there is a chance as well that the company could benefit substantially from a COVID-19 vaccine next year. So the third and final outperforming stock we're going to talk about, and one that is most surprising to us, is Rogers Communications, trading under the ticker RCI-B. Now Rogers is a solid company. We're not questioning that. Other popular telecom companies like Quebecer, like BCE, like TELUS, they've all taken at least 10% hits to their share price. So the fact that Rogers has essentially broke even, I mean they're up maybe 0.1% since the market started to crash in late February, is actually fairly surprising. So before we get into why Rogers on its own has done better than most, let's get into why we think telecom companies have outperformed and why they will continue to outperform. The telecom industry is very capital intensive, and what this means is companies must take on a lot of debt to build infrastructure to eventually turn that infrastructure into revenue generating assets. And when interest rates are higher, these companies tend to struggle because it costs more to borrow money. But as we see in 2020, there has been a drastic cut in interest rates even over the last month. We've lost about 1.5% to the prime rate here. These companies will be able to borrow money for rates we haven't seen in a very long time. Another reason is obviously as we sit at home with physical distancing and health laws in place to protect us, we're truly understanding how important these companies are to let us connect with our families, to let us surf the internet when we're bored, to talk on the phone, to work from home, using our internet to work from home, to still make an income in all this craziness. And as such, it's pretty clear that these companies are going to continue to grow their subscriber base over time. And although they're losing customers in, say, their television departments, they're more than making up for this with the addition of wireless subscribers. Canadians pay some of the highest data rates in all of the developed countries in the world. And there's a significant moat with the three major telecom companies, Rogers, Bell, and TELUS. Now, why are we surprised with Rogers' outperformance at this time? For one, Rogers probably has the worst dividend out of all the telecom companies. The company pays around a 3.5% yield, and they didn't raise their dividend last year. Compare this to 11 years with Bell, 16 years with TELUS, 16 years with Quebecer. Like, all these telecom companies have long histories of increasing their dividend. It's also key to note that over the last 5 years, Rogers has a 5-year dividend growth rate of only 1.8%. This is also significantly lower than BCE at 5%, TELUS at 8.18%, and Quebecer at around 11.5%. The reason I feel more investors are heading to Rogers is simply because of its 5G capability. The company is likely to be the first telecom company to roll out 5G capability here in Canada, and this could make them one of the fastest growing telecom companies in Canada moving forward. However, if you're looking for more stable income options, companies like TELUS, BCE provide healthier, safer dividends. Now, another reason for Rogers' outperformance may be due to the fact that before the crash and even now, it's the cheapest telecom company in terms of the big three. Even after companies like BCE and TELUS have taken a 10% hit to their share price, they're still, on a forward price to earnings basis, more expensive than Rogers. Now, a lot of people tend to tell us that the government is going to be coming down on telecom companies and forcing them to reduce their prices. And we've seen the Liberal government do this not too long ago, telling telecom companies that they need to cut the prices of specific plans by 25% in the next 2 years. The thing that isn't really disclosed that often, unless you really look, that these plans are ones that contain anywhere from 2 to 6 gigabytes of data. Not sure about you, but the last time I went to a telecom website to look at phone plans, the lowest data plan I could find was essentially 10 gigabytes. And with data usage going up, we feel over the next 2 years there's actually going to be less and less people on these 2 to 6 gigabyte data plans, and as such it's not going to affect these companies as much as people would like to think, and it may just be the Liberal government filling in an election promise. So that's pretty much it for this video. Remember to comment below any stocks that you feel are outperforming, ones that we might have missed. I mean, we can't cover everything, and we love to see comments. We try to respond to every comment as quick as we can, and we want to see what stocks you're looking at moving forward in 2020. Like the video, subscribe to the channel. We got a ton of great content coming your way, and you're not going to want to miss out. Till next time.